Welcome to the AAMA Quarter Market Commentary. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is Phil Volker, AAMA's Chief Investment Officer. Good morning, Phil.
Morning, Bob.
The media is teeming with market downdrafts and economic and political headlines that are significant to us and our clients. So today, we're going to maybe walk through, or maybe we should tiptoe through these important topics that hopefully will provide some clarity to what's going on in the marketplace. So let's get right into it. Phil, can you kind of give us an update on the fiscal policy that's going on today?
Sure. And if we're in general looking for clarity, some of these things it's going to be hard to come up with clarity today. But certainly it appears that there is a trend towards reducing federal spending, certainly in some areas. And if we look back in history, federal outlays post World War II generally ranged from 15 to 20% of GDP. In the last 10 years, it's been closer to 20 to 25%. And of course, we had the big spike up for the pandemic. But to go from the 25% current rate down to 20 or down to 15 would require cutting spending that could be a ding on GDP as much as 1.5 to 2, 3, closer to 3%, depending upon what kind of multiplier you apply to it. But I think a rule of thumb would be 1.5 to 3% decline in GDP from reduced government spending.
Interesting. You know, a big topic has been the tariffs, and I kind of joke around and say to tariff or not to tariff is the question, but there's some significant potential ramifications of all these tariff threats and actual tariffs that are being employed against countries. What's your take on all this?
Well, everybody agrees that a tariff is essentially a tax on the consumption of those goods. And we also know that there's been a lot of volatility in the tariff policy, although in the last week it seems to be relatively clarified. One thing that we need to keep in mind is that, and we don't know the answer to this, but some tariffs, as you just suggested, may be an effort to get a negotiation started. But in particular, negotiations on trade barriers. Trade barriers are those things that are erected by countries to keep foreign goods out of their economy and may not even have a tariff involved. So regulations in the European Union on ingredients for food precludes a lot of our food products from being imported in Europe. There are other trade barriers around the world that are targeted against the U.S., and it's possible some of the tariff policies are aimed at trying to get some of those negotiated out. But bottom line is that any tariffs are a tax tending to reduce consumption and change consumer behavior, either by looking for substitutes or just lower spending on those higher cost goods.
Sure. And I was reading an article I think you sent to me about the tax-free haven Ireland, where a lot of companies have funneled profits through Ireland on the tax-free status and been able to avoid U.S. income taxes. So I think the conclusion of that article was maybe this was a way to start collecting some taxes from companies that really haven't paid much. So let's take a moment and talk about artificial intelligence and what's going on in the economy and the markets with that.
Sure. You know, we've written about it occasionally artificial intelligence has the potential to improve productivity long term. But it's made our list of significant impacts right now because there's been a lot of investment in data center build outs, and that's had a positive impact on the economy. There's some reports of some of the large companies starting to back away from those projects. If there is a broad move away from building some of these data centers, that will be a negative near term for the economy. So it's one of our large moving parts right now, among others.
Just a few of the big moving parts. Um, let's shift a little bit to the economy and bottom line, what we see going on there at the moment.
As everybody recalls, the last 3 years of higher interest rates triggered every single tried and true recession indicator. Everybody was predicting a recession 2 years ago, 1 year ago, etc. We've been pretty consistently positive or constructive on the economy, which has been correct. Although last summer we did suggest that we were approaching a time where economic weakness could start to develop, and we mentioned 2025. What we've seen actually happen is some of the hard data starting in February started to decline. Personal consumption expenditures, construction expenditures both declined significantly in February, which brought some forecasts down to a negative 2% GDP for the first quarter. Consensus is still positive, but the Atlanta Fed GDP now is now negative for the first quarter. So the jury's obviously still out, and there's a lot of information to be reported between now and June 30. But if we do have a negative first quarter and it's followed by weakness in the second quarter, then that could meet the technical definition of a recession. One thing I should say is that due to economic activity that's been designed to front run tariffs, will probably provide a short-term boost to all these numbers. Companies have been buying ahead on materials. PC shipments have been up significantly. So there's a surge of tariff front running that could help hold up the economic numbers together.
And some of those changes were pretty significant. I mean, we were supposed to be up like 2%, and now we're down minus 2%. So, I mean, that's a 4 percentage point swing, which is pretty significant pretty quickly.
It is. And it just points out the fact that there are, as the title of our commentary, many very large moving parts. And just like volatility in the stock market, we expect that a lot of these numbers are going to be volatile going into the second quarter and later throughout the year.
Yeah. And I know we touched a little bit on inflation, but any other thoughts on inflation?
Well, we've written about inflation for 3.5 years now. And the, inflation obviously has come down a lot. But the last 3 months of the Fed's favorite gauge, the core PCE services number is at 4.1 on average, which is the worst reading over the last 12 months. So inflation has been slowly picking back up in the last several months. And I think that bolsters the Fed's position to stand pat. We don't have weakness yet showing up in the labor market. So, there's little motivation, I think, for the Fed to change their policy. And meaning to reduce rates further.
And they got to worry about making a mistake. They cut rates and inflation goes up, and the economy stalls out into a recession, which could be a pretty bad move too early.
That's true. Yeah, the Fed is typically late historically for the last 115 years. They've been late or wrong. They were late 3 years ago, and there's a risk that they'll be late again.
Absolutely. Let's shift over to the stock market. Give us some insights there today.
Yeah, everybody's first question is going to be, when's the stock market going to bottom? We don't know. What we do know is that two things. One, the market has been overvalued, was overvalued going into the highs of February. And in fact, earnings forecasts were coming down significantly starting in mid-December. So if you forget about all of the headlines on tariffs and fiscal policy, the ingredients for a stock market correction, some kind of decline, were in place before all these headlines hit the wires. So the stock market had been trading, I'll say, 85 percentile of its valuation level on a forward PE, and it's come down. Stock price weakness has brought it down to 68th percentile. So it's less overvalued than what it was. But at the same time, earnings numbers continue to come down. So prices are chasing that declining earnings forecast. So the two are working against each other. But right now, valuations today are better, but still relatively overvalued.
Well, and the impact of tariffs, they're going to be paid someplace, whether are paid by the consumer in higher prices or they come out of corporate profits. I mean, I saw Walmart this morning said they were going to try to digest as much of the tariffs as they could internally, but that's going to have a pretty dramatic impact if and when we know the final negotiations of all these tariff rates.
True, and large buyers like Walmart do have direct negotiations that they've always maintained with their source countries, and they tend to negotiate prices lower to help offset the tariffs.
Sure. So, the big question is, how many more elephants can we shove in the room before the room explodes? But there's a lot of cross currents out there today. We really appreciate everyone's time today. We try to keep these about 13 to 15 minutes. So if you'd like to have a conversation about our thoughts in more detail, please feel free to contact us. We're available basically almost 24/7. We've always prided ourselves in being available to field questions and conversations with advisors anytime. So please reach out to us. Thanks again. Thanks, Phil.
Thank you.